So now we are going to talk about what happens when we sell a call option in the simplest way possible. Quick recap. Every trade has two sides, a buyer and a seller. Selling a call is like being the store owner. Remember the phone coupon example. Before you were the buyer, but now you are the store and you sell the coupon. You are no longer the buyer of the coupon, you now the seller of the coupon. Step number 1, you collect the premium. You sell a call option, you receive money upfront. In real life example, you own a phone store, you sell a coupon for $5. The $5 is yours immediately. Step number 2, you promise a price. The coupon says the buyer can buy the phone for $120 at any time in the next 30 days. Then you must sell at $120 if the buyer wants it. In trading, the $120 is the strike price and the expiration date is 30 days. Step number 3, you wait and watch. You already have the $5 right now. Now you hope the buyer never uses the coupon. If the price goes down, buyer won't use it and you will win. If the price go up, buyer might use it and you could lose. So scenario number 1, the price drop to $90 and you win. The buyer tears up the coupon and throw it away. Because why to buy at $120 when the market is at $90? You keep the $5 as a profit. Scenario number 2, the price stays at $120 and in this case you also win. The coupon expires worthless and the buyer does nothing. You keep the $5 as a profit and that's another win. Scenario number 3, the price jumps to $150 and in this case you lose. Why? Because the buyer used the coupon and you must sell the phone at $120 even though the phone price right now is $150. So you lose $30 on the phone minus the $5 you collected from him when you sell him the coupon, and for that the net loss is $25. So your max gain is the premium you collected, the $5, and your max loss is unlimited because the phone can go as $1,000, $2,000, and more the phone price go up, more you will lose. When do you profit? You profit if the stock price stays below $125. So below $120 you keep the full $5, and between the $120 and $125 you keep part of the premium. When do you lose? You lose if the stock price rises above $125. The higher it goes, the more you lose. There is no limit to your loss. So we are going to use SPY to sell a call. So let's say we are going to sell the call or the phone from now until 30th of April or the 1st of May. We think the price of the phone will not drop below, let's say, 714, 713, 712, 710. We sell a call. And we are going to use one contract for that. And for that, we are going to get $871 in a premium. As you see, the credit is 872 minus the 65 cents, the break-even stock price. So if the phone price or the stock price reach the $718.72, we will win and we will not lose anything. If the stock price or the phone price stays above this price, let's say 720, we will win. If the stock price go down 718, we are going to lose from our premium. That's $872. And that's it. Thanks for watching and please subscribe.